Welcome. This is a special briefing from ABBA Research on a developing situation that we believe has systemic implications for the global markets, a situation we're calling the 2026 software shock. Sauce is dead. Okay, let's just dive right into this. That sounds pretty provocative, right? But what we're seeing is that this isn't just a prediction anymore. It's rapidly becoming a market reality. And honestly, this one idea is the catalyst for everything we're about to discuss. All right, so here's our roadmap for today. First, we'll look at how AI is just tearing up the old software model. Then we'll explore this really crucial connection to the private credit market. From there, we'll dig into the hidden risks, the stuff that's not being reported. Then we'll look at the first big warning sign, the canary in the coal mine, so to speak. And finally, and most importantly, we'll walk through a clear action plan for you as an investor. All right, so it all starts here. For decades, the per-seat business model was the engine that created literally trillions of dollars in software value. Well, that engine is now being systematically dismantled. So let's get right to the heart of it. In the past, it was simple. A company's value was based on the number of human users, the number of seats. Nice and predictable. But the future? Totally different. Now, value is based on what an AI does, the automated tasks it completes. You're not paying for human access anymore, you're paying for machine-driven results. And that one shift guts the entire economic foundation of the SaaS industry. And this is not some far-off theory. Look at this number, minus 18%. That's the average reduction in software applications per company, and this is data from 2025. It's happening right now. CFOs are taking an axe to their software budgets because AI agents are taking over those workflows, making those expensive human seats redundant. So, the software world is in for a shock. But here's why this isn't just a tech story. This is a financial story. Because one very specific and very large corner of the market has made an enormous, concentrated bet on SaaS. Let's talk about the private credit connection. Just look at the scale of this. In the year 2000, private credit was about a $46 billion market. You fast forward to 2023, and it's a $1 trillion behemoth. After the 2008 crisis, when the big banks pulled back on lending, these guys stepped into the void and became the primary lenders to thousands of mid-market companies. And here it is. This is the critical link. A full quarter, 25% of that entire $1 trillion market is directly exposed to IT and software. That is a massive, concentrated bet on the very sector that, as we've just discussed, is facing an existential crisis. This is the transmission mechanism for the contagion. So, we have a huge market with massive exposure, but the real danger is amplified because this part of the financial world is, well, it's a black box. There are specific mechanisms in private debt that are designed to conceal stress, delaying any recognition of losses until it's far, far too late. Let's talk about the first key mechanism, PIK, or payment in kind interest. You know, it's kind of like this. Imagine you can't make your mortgage payment this month. But instead of you defaulting, the bank just says, no problem, we'll just add this month's payment to your total loan balance. See, on paper, you're current, but in reality, you couldn't pay. That's exactly what PIK does. It creates these shadow defaults that hide the real stress in the system. And this shows you just how big that hidden problem is. The official reported default rate is about 2.1%. That's what everyone sees. But when you factor in all those PIK modifications, when you look under the surface, the real number, the shadow default rate, is closer to 6%. That's nearly 3 times higher. The vast majority of the risk is hidden. And it gets worse. You combine PIK with something called covenant-light loans. Covenants are just financial guardrails, rules that a borrower has to follow, while cov-light loans have basically no guardrails. So you can have a company that's bleeding cash, its business model collapsing, but it never technically trips a wire. It becomes a zombie company, kept alive on paper while its real value just evaporates. Okay, now this comparison is really the core of our entire thesis. In 2008, you had CDOs, which were bundles of subprime mortgages. The big diversification myth was that a housing crash in Florida wouldn't affect one in California. We all know how that turned out. Well, today, we have CFOs, collateralized fund obligations. The underlying asset isn't mortgages, it's stakes in these private credit funds. And the myth is exactly the same. One software company failing won't affect another. But what happens when the entire SaaS business model is disrupted by a single systemic AI shock? The whole model breaks. It's the same structural flaw all over again. So this creates a really dangerous dynamic we call the NAV loan liquidity trap. Here's how it works.
First, the fund keeps its company valuations artificially high. Second, they borrow a ton of money against that inflated value. Third, they pay that borrowed cash out to their investors, creating this illusion of great returns. But it's a house of cards, because in step 4, a real-world shock forces a write-down, and boom, you get a catastrophic margin call. They're borrowing from a future that may not exist to paper over today's problems. Now, I know this might all sound like a theoretical risk, but this is no longer a forecast. In February of 2026, we saw the first major event that tells us this crisis has already begun. The Canary has appeared. The parallel to 2008 is, well, it's unmistakable. In August 2007, BNP Paribas froze funds tied to U.S. subprime mortgages. It was the first big public signal that something was deeply wrong. Now, fast forward. In February 2026, Blue Wall Capital, a giant in the space, freezes redemptions from one of its major funds. And what did they cite as the reason? Pressure from its software loan portfolio. It's an echo. It's the same kind of warning shot. And we're not the only ones who see it. When a seasoned market observer like Mohammed El Arian looks at the Blue Owl situation and asks, is this a canary in the coal mine similar to August 2007? Well, that's when investors really need to pay close attention. Okay, let's get to what is probably the most important part of this briefing. What do we do now? Let's talk through an investor action plan for navigating this new environment. First up, the sectors to avoid. Look, the business models of these market darlings, Salesforce, Adobe, ServiceNow, they are fundamentally threatened. The defensive moats that made them seem invincible for years, they're evaporating because of AI. This includes security software, data infrastructure, the whole shebang. So where do you go? The key strategy here is a rotation. Get out of that overvalued, threatened tech and move into undervalued, more resilient sectors. We're talking about things like U.S. small cap value, especially industrials. For the AI theme, you want to own the picks and shovels, the companies building the actual infrastructure. And in credit, you want to be in areas that can benefit from this dislocation, like asset-backed credit that has nothing to do with software. Now, it's really important to understand that we are not predicting an exact repeat of 2008. That crisis was an acute event, a sudden financial heart attack, like the collapse of Lehman Brothers. What we see coming is more of a chronic crisis, a prolonged, grinding credit crunch that starves the real economy of capital. It's not a heart attack. It's more like a slow, economic, multi-organ failure. And that brings us to the fundamental question that we think will define investment success for the next several years. As all this risk moves from the regulated public markets into these opaque private ones, how do you have to evolve your own strategy to see what's been hidden in plain sight? Thank you for your time today. This briefing was based on a much more detailed research paper, and we really encourage you to download the full report from our official site at alpha-beta-research.ai.